This month, Life Insurance Strategies Group is in Newport Beach, California. And this is where we're talking about taking money out of a life insurance policy, specifically distributions from private placement life insurance. Now, if you've tuned into a lot of our videos, you know a little bit about private placement life insurance and the reasons people use it. Well, one of the popular designs when purchasing private placement is to preserve the ability to take out later tax-free loans as well as withdrawals that are always tax-free from a policy. Now, there's a little bit of a difference between when you take money out of a private placement life insurance policy and when you do that with a retail policy. Now, for example, if you have, say, a Northwestern Mutual policy and you want to take out a loan, you can go online, request a loan, and they'll probably wire you the money the same day or maybe the next day. With private placement life insurance, things are a little bit different. A life insurance company does not front their own money. So in order to be able to take a distribution, which is a word we use to encompass both loans and withdrawals from a private placement life insurance policy, first, the carrier has to sell the underlying investments. And they're going to rely upon the investment manager to decide which investments to liquidate in order to get the cash for the policy. So remember, the owner of the policy can't make that decision. That would be a violation of investor control. So the manager that the carrier has signed with to make decisions about the policy will make that decision on what to sell. Now think about it. In private placement, oftentimes a lot of the investments underlying the policies are alternatives. They might have lock-in periods of 5 years or more. And so it might be difficult to choose the right investment to liquidate. And then also, once you've liquidated the investment, you've lost that earning potential in the policy. So let's say you've sold something that's earning 15% and that's gone. So you've taken that from the growth possibilities of the policy. And that's not to say you shouldn't take money out of a private placement life insurance policy. However, traditionally, we haven't seen a lot of money taken out. I can tell you that in probably my 21 years of working in private placement life insurance, I've seen less than 10 policies ever touched for a distribution. I think that'll change going forward as private placement life insurance has increased in popularity and because of the changes to the 7702 tax code, where we saw an increase in the ability to put more money into life insurance policies for accumulation. I think we'll see more people adopt private placement for the thought that, hey, in the future, I probably will touch the policy for distributions. So particularly the people in their 30s and 40s that are putting money away on these policies, and 30 years, 40 years down the road, might be in a position where they want to take money out. But they should understand that, again, things are different when you take it out of PPLI, and you really need to have your money manager, your investment manager who controls the investment decisions about the policy, handle the sale of the underlying assets correctly so that you get the optimal return that you can get in the policy once you've removed some potentially high earning investments. Now remember, at Life Insurance Strategies Group, we don't sell products. We help our individual and institutional clients make decisions around life insurance where there's some complexity. If we can help you, reach out to us at lifeinsurancestrategiesgroup.com.